Thank you so much for the friendly introduction. Hello, everyone, and good morning. Thank you for coming to this session. As was said, I'm Karsten Weide, IDC's VP of Media and Entertainment, or in less pompous words, I'm IDC's new media guy. Today I'm going to present to you the results of a research project that we've done for Programmatic, which was entitled Programmatic Advertising in the United States and Worldwide, 2013 to 2018. So essentially what we're trying to do with that research is to figure out, well, first of all, the numbers, how much money is going to go through that market, but also secondly, what are the trends that are driving that growth in that particular market. Just up front, what we're going to see is a lot of growth. We're going to see a lot of proliferation of programmatic within the digital space to new formats. But we're also going to see a proliferation of programmatic even to other media, like television and radio. And I've called out this quote from an Ad Age article from back in June, where they had reported that out of Procter & Gamble it emerged that they planned to spend 70 to 75% of their spending in digital programmatically. Not only that, they plan next year to do the same thing in the mobile space, i.e. in 2015. We've heard similar things about American Express, even though Procter & Gamble is probably the more interesting example because it's, they're running brand campaigns, whereas American Express is doing more direct response campaigns. But still, you have two major heavyweight brands that are telling you, we're going to spend the vast majority of our digital budgets programmatically. So with that said, let's look at some of the numbers. So first of all, we're going to talk a lot about numbers, $1 billion there and $5 billion there. It doesn't really tell you anything. I might as well say it's a trillion, Albanian crons. It doesn't tell you anything. So what we're going to do is we're going to put it in relation to something else, namely the total addressable market. That's what this chart shows you. This is the worldwide spending on display advertising, everything. So it's online display, it's online video, it's also mobile display and mobile video. So a steadily growing market. And now let's see how much of that is going to be programmatic. So let's take it from the top. So as you can see, there's going to be tremendous growth in this market. So I'm not going to go down the billion numbers because they're not that interesting, but what is interesting is two things that I want to point out in this particular chart. So first of all, let's take a breather, let's take a step back, and let's really look at these numbers. So what we're really talking about here is an industry or an industry segment where today, on a worldwide basis, really only about 1/10 is automated in some way, shape, or form. But only a little more than 4 years away, you will see an industry in which almost 2/3 of the spending are going to be automated in some way. So we're going to see a tremendous change in the display advertising segment. And what it means is that the way that our industry works and that we work within this industry is going to change very, very dramatically in a very, very short time span. So incidentally, what you see there, 63% CAGR, in plain English, that's the average annual growth rate in this particular segment. So each year that goes by, we're going to see more than half again in spending. So 60% more next year, 60% the year after, and that's how you get to this tremendous growth. So that's number one. Now let's look at where that growth is coming from. And when I say coming from, I mean literally geographically. So as you can see, the United States is going to be the major source of this growth. It is today, but it will also be 5 years from now. The second biggest source of that growth is going to be Europe. And in Europe, as was the case in the last year, it's going to be the three major markets, going to be the UK, France, and Germany. The difference this year is that the UK is pulling ahead of Germany and France. They used to be fairly even up, but that's not the case anymore. In terms of maturity, the UK is almost even with the United States now. Germany and France falling a little bit behind, even though there's still tremendous growth there also. And Germany falling a little bit behind France, which, I as originally German, as you can tell from my accent, I'm ashamed to say. We always pride ourselves on our technology and engineering, but in this case, we're kind of falling behind. The reason is that the German market is just tremendously conservative. So if it's new, it can't be any good. So let's see what the other guys are doing, and then we can adopt it later on. That's what's going on there. Another important market is Japan, of course. Interestingly, 2 years ago, Japan, in terms of relative maturity, wasn't even on par with Germany and France. Then last year, they pulled up to Germany and France, and this year, they pulled up to the UK. So same level of maturity there with the UK. Actually, we think that the UK and Japan, by the end of the forecast period, 2018, they will be almost on par with the United States in terms of penetration of the market with programmatic spending. APAC, there's really only 2 markets right there that are interesting. One is Australia, which is fairly big. It's a small market, but very mature. And China. China is not very mature, but even with a very low penetration rate for programmatic, it's such a giant market in terms of spending, you get a lot of spending in programmatic. So it's a very interesting market going forward. Not really today, just yet, but going forward, it's going to be very interesting. All right, before we go any further, let's talk about some of the terms. As you all know, as you are all well aware, there's a big hodgepodge of terms and big confusion about the terms in this particular industry segment. So let's go through the terms real quick. So we're talking today about programmatic. Programmatic really only means it's software being used to automate and smoothen the process of trading, advertising, and operating it. That's really all that means. It consists of 2 parts. One is the part that's called RTB usually, or open RTB. That's really the segment that that you're most familiar with probably. That's where the most growth came in the past. That's the open market, spot market, where RTB is used to transact that. The other big segment, which is younger, is Programmatic Direct. Now, Programmatic Direct uses technology or software to automate and optimize direct sales. And again, that falls into 2 parts. One is private marketplaces, which use technology to automate trading. But they're private, they're not open, so there's more control, both for the advertiser and the publisher. And the other part is automated guarantee, which is the use of software to automate the workflow only. So there's no trading involved. It's really only meant to automate and optimize what's already happening in the direct sales space and smoothen it. So now, what we just did for the world, let's do for the United States in more detail. So again, this is display advertising spending in the United States. The same footnotes that I just said for the world go here too. Oh, and by the way, going forward, when I talk about spending in a particular segment, I always mean managed revenue. I never mean the take that vendors take. That's much smaller. But this is really the managed revenue. That's the amount of revenue that goes through programmatic. So first of all, let's compare to the world. As you can see, the growth there is much more dramatic even than for the world. Unsurprisingly, because the US are advanced in terms of the maturity of this segment versus the rest of the world. But what you can see is that by 2018, we're in a world where the traditional way of spending or selling advertising or buying advertising is really going to be a fairly small portion of the market. We think it's probably going to be more like 20%. Whereas all the rest is going to be automated in some way, shape, or form. Now let's look at the details. Where does this growth even come from? So let's take a look at that. So first of all, let's look at open RTB. So that's the oldest segment in programmatic where the most growth came from in the past. That's really sort of the final stage of the automation of what used to be done by advertising networks, which was then automated using ad exchanges, which was then automated using RTB, real-time bidding. So there's a moderate contribution here to programmatic. But interestingly, what you can see is the annual growth rate, the average annual growth rate is fairly low. It's only 27%. The reason why that is because this segment is almost completely saturated already. You have probably probably by now, almost 50% is being done on RTB basis. And by the end of the forecast period, it's going to be more like 65%. And that's everything. Includes mobile, includes video, even though those two segments are a little bit behind online display. If you only look at online display, you already have a 2/3 penetration. And by the end, 2018, it's going to be like 85% is going to be RTB based if you just look at online display. So that's the major source of growth in this segment in the past. Then there was another segment, which you know as private marketplaces, which is essentially the same thing, only that it's in a private marketplace, so it's more control. That's for publishers who said, yeah, we want to monetize our unsold inventory. We do want to sell it on an RTB basis, but we don't want to do it in an open marketplace. Primary reasons probably because the eCPM rates were so much lower than on ad networks or ad exchanges that they said, we want more control. This is another 20% of the above segment, so it's a nice little contribution there too. So far, so familiar. Now let's look at the stuff that's new. So first of all, this is guaranteed private marketplaces. So what this is the attempt to use a software platform to not only automate the workflow of direct sales, but also have the sales being done automatically in some way, shape, or form. And as you can see, there's tremendous growth here. So, last year it was probably just 3% or 2% of total display. By the end of the forecast period, it's going to be over a quarter is going to be done on private marketplaces. So it's all guaranteed sales. And the annual growth rate is over 100%. So spending will, on average, double each year as you go forward until 2018. So a tremendous amount of growth. One of the reasons why there's so much growth is that, of course, the guaranteed segment is about twice the size of the non-guaranteed segment. So there's a huge total addressable market, much bigger than the non-guaranteed one. So there's a lot of space to grow. So that's the guaranteed private marketplaces. Now let's quickly look at why this growth is happening in guaranteed. So this is primarily, as most of you will know, this is primarily driven by the demand side. So it's really the buyers that drive this process. The buyers, and by buyers I mean agencies, but also brands, they love automated guaranteed sales. They love guaranteed PMP. And the reason why they do is because they get everything that they get in direct sales. They retain planning certainty. They get a 100% book-to-run ratio. So complete control over a campaign that's going to happen, a month from now or a couple of months from now. So they love that. But not only that, they also get better guarantees. So, in traditional sales, often what you have, the publisher defaults on the guarantee. Usually that happens because forecasting was off. Our forecasting capabilities in this industry are not that great yet, so that frequently happens. And then you have to go back and laboriously, negotiate a make-up or a true-up, which is, of course, takes a lot of time, and it's annoying. It's obnoxious to do. Now, in this particular scheme, those guarantees, but also the penalties in case of default, would all be part of the contract already. So it's better guarantees. It works smoother than the past. But not only that, the workflow is just more efficient. So you spend time, you save money on the cost side, just because everything's integrated, it's automated, it's optimized. So things are more easy to do. There are fewer errors. It's faster. So that all saves money. And beyond that, of course, you also have better ad efficiency, thanks to targeting and thanks to impression level decisioning. Now, targeting, of course, has been around for a while, but the impression level decisioning gets you another 10-15% effectiveness increase. So that's something that the agencies are also very happy about. Now, all of that they get, they don't have to pay anything more. We talked, as part of this project, we talked to advertising agencies. And we asked them, what's the price difference between your guaranteed PMP and the traditional sales process? And they say, on average, what we found out, prices were actually not that much lower, as opposed to the non-guaranteed space, where they are a lot lower. Used to be 25% lower, now it's more like 17% lower. But here, they're basically flat on average. Of course, there's cases where it's a lot more expensive, there's cases where it's cheaper, but on average, it's basically flat. So they're happy about that too. All in all, they get a better return on investment. So they spend less money on running the shop, and they don't have to spend any more to do so. So ROI is better for them. Of course, for publishers, it's also a good thing. What publishers really want is they do want the efficiencies that come out of using programmatic, but of course they want it without having the risk of possibly lower eCPM rates. They don't want that, of course, and very understandable. Can't blame the publishers to think that, or to be anxious about what programmatic is going to bring for them. But of course, the efficiencies they still want, and so to the extent that you can guarantee safety for the publisher, so that you don't pour out the baby with the bathwater, they're happy to embrace programmatic. Which takes us to the next slide, which is another growth segment in the programmatic space. Now this is new. This is called automated guaranteed, as I said previously. That's technology that you use to automate the workflow, but without doing the actual trading through an algorithm. Still humans trading from human to human. It's just automated. And we think there's going to be a lot of growth potential there, because that really speaks to what I just said about the publishers, namely that you can save money by streamlining your operations without having the risk of lower eCPM rates. And so if you look at this chart, what you'll see is it's actually a little bit bigger. I don't think the chart really shows that very nicely, but it's actually a little bit bigger than PMP guaranteed. So there's a lot of potential there. This year, it's probably going to be only 3% of display. But by the end of the forecast period, it's going to be a good $10 billion, which translates into 27% of total display spending. So there's a lot of potential there as well. So now, what's beyond the horizon, or what's on the horizon? As I said before, there's going to be a lot of expansion into other media even, and other advertising formats within digital. So let's look at that for a moment. So first of all, let's look at native advertising. Native advertising is advertising that tries to basically mimic the editorial content around it, in which it is embedded. So it looks similar to the design of a web page, but it's also trying to be similar in terms of the content matter. And the idea is, of course, to overcome, sometimes it's called banner blindness, but let's just call it advertising blindness. And it works really great. Actually, effectiveness rates are a lot higher than for run-of-the-mill ads. There's quite a bit of spending there already, but it's still fairly new. Most of the spending happens in the social space. So if you go on Facebook or you go to Twitter and you look at the news feeds, the ads that are inside this news feed, that's native advertising. So we think that's probably 2/3 of today's spending in native advertising is social spending. So it's on Facebook. It's either on Facebook mostly probably at this point, and some on Twitter and some on LinkedIn. Now, hardly any of that is so far automated. Probably only just 1% at this point. It's really new actually, but that's about to change. Facebook already has the capability. Twitter last year or recently bought a company to do the same thing, to be able to trade this programmatically. So that's going to be a big deal. So that's why you see a lot of growth in the native advertising space. And how am I on time? Can anyone tell me? 26. Good. So I have 4 more minutes. Perfect timing. Good. So let's talk about radio and television. So that's really, and I have to admit, the most speculative part of this presentation. And it's speculative because there's so little to go on. So one of the things that as an industry analyst you always hate. Emerging industries are always hard to deal with because you don't know anything about them, and yet you have to say something about them. So what we did is we interviewed some vendors, and again, we talked to some advertising agencies and basically asked them, where are you today with programmatic television or programmatic radio? And the situation is that there's actually quite a number of vendors in each of those segments that are already active. I want to say in the United States, it's probably like half a dozen companies, and companies like Jelly, for instance, who are active in this space. Same for television. Now, today, radio is probably a little bit ahead of television. So radio, we think, it's maybe, 1% of total spending is in some way automated, is in some way programmatic. So amounts to about, maybe $200 million, not a whole lot. Television is even farther behind. So we think that this year, so 2014, probably not even 0.1% is being traded programmatically. But that's going to change, we think. We think that by the end of the forecast period, 7 to 8% could be programmatic. Now, 7 to 8% doesn't sound like a whole lot, but if you apply it to an industry that's as monstrously big as the TV industry, that's a lot of money. So by the end of the forecast period, you look at $10, $11 billion in programmatic television advertising with a market penetration of only 7%, which tells you, well, if it's 7% in 2018, where is it going to be in 2023? Just do the math. It's 40% of television. There's going to be a huge amount of money that goes through programmatic. There's a huge growth potential there for the industry. And radio penetration will be similar, but the industry is much, much smaller. That's why the contribution is much smaller within this chart. But the bottom line is tremendous growth in other channels and other media. So in conclusion, let me just summarize. So first of all, we're going to see tremendous growth in this industry. There's going to be a lot more money going through it 5 years from now than today. Second of all, as you did see in those charts, programmatic direct is going to be the major growth, the key growth segment in programmatic. So you're going to see a lot of spending on automated guaranteed, but you're also going to see a lot of spending on private marketplaces going forward. The growth in programmatic is primarily driven by agencies, but also by brands. As a matter of fact, you will probably see some brands, who will say, I'm not even going to go through the agency anymore. I don't really know why I should go through a trading desk. I could deal with a DSP directly. Why not? Some even say, dear DSP, I don't want you to do the work for me. I want you to give me your software platform. I'm going to pay you some money for it, and I'm going to do the DSPing myself. So there's going to be a lot of disintermediation on that end of the value chain. So tremendous interest both from agencies and brands, but also for publishers. I think today there are a lot of offers where publishers can actually get what they want, namely the upsides of programmatic without the risks of it. And going forward, I think they will see that the fears of eCPM rates that go in the basement and are really worse than they used to be in direct sales are really unfounded, largely unfounded. But at the same time, they're going to save a lot of money on the cost side. So it's going to be, I think, very attractive for them. So as I said, 5 years from now, our industry is going to look very different. And with that, I thank you for your attention.